can invest in a wide variety of products when they build portfolios, and a lot of them can do a good job of improving your risk-adjusted returns. One such asset class is residential mortgages. Have you ever considered putting residential mortgages into your portfolio to get a better risk-adjusted return, especially as a comparison with things like bonds or GICs? We're going to be talking to an expert about that this week.
This is Make Better Wealth Decisions, a podcast about financial blind spots, decision-making, and how the reality of higher rates, global tensions, and tariff instability impact your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto.
This week, we're speaking with Gord Ross. Gord is the Regional Vice President for Central Canada for sales for a company called Capital Direct. Gord, how are you today?
I'm doing great, John. How are you doing this morning?
I'm doing fine. Residential mortgages are the sort of thing that everyone, it seems, knows a little bit about because most Canadians are homeowners and those that don't wish they were. And so everyone has a view on mortgages and having them for their own property, but not a lot of people think about investing in mortgages, buying a basket of mortgages as an investment vehicle. And I think it's useful to have that discussion because in a time when interest rates are relatively low, mortgages might be a good way to get broad diversification and maybe a slightly higher return than if you were just buying a bond or a GIC or a basket of bonds or a mutual fund or an exchange traded fund that just buys bonds. So can you maybe take a moment to walk us through the benefits of investing in residential mortgages for retail investors?
Sure I can. And that's exactly how we think is what you just described, John. So it's sort of a well-known fact, I think, at this point that residential mortgages are, very lowly correlated to traditional markets, traditional bond markets and equity markets, and therefore can make up a compelling portion of an investment portfolio. I think the challenge with mortgages is real estate. So, I've been in mortgages in the real estate area for a number of years now, and it's been many times where clients are a bit timid or a bit afraid of real estate, in general, not understanding that a basket of, Canadian residential mortgages is still a very valuable part of an investment portfolio, even though there might be parts of real estate which appear to be scary in the media, let's say.
Right.
So it is a great asset class. The returns from many of the companies in the mortgage space are very consistent, very reliable. So again, the way obviously that we position it is for clients that are looking for that sort of steady, dependable income stream and are maybe a bit disenchanted with GIC rates or how bonds are performed over a decade or whatnot. This might be a great opportunity for them to look at a different asset class.
So one of the things that I've been reading about in 2026 is that the economy is slowing down. A lot of people are concerned about that to varying degrees. And by extension, there are concerns that might spill over into capital markets. Now, one of the things that happens when the economy slows down is that sometimes it's because people are losing jobs and there are concerns about what's going on with geopolitical uncertainty and tariffs and so forth. So is there a concern in the mortgage space that perhaps the people that are taking out the mortgages might not be quite as creditworthy today as they were 1, 2, 3 years ago, just on the simple basis of the economy being a little more tenuous?
Yeah, that's a good thought. I think that's something that everybody needs to think about. And unemployment is certainly a scary proposition, no matter what asset class you're in or where your investment portfolio lies. If you become unemployed, many things can change quickly. But again, from our perspective, one of the things that we look at during the portfolio construction process is the likelihood of repayment. Right. So the decisions that we make in our process are such that we are going to have the highest propensity to get the returns that we've identified that we want to get for our clients, no matter what happens in the economy or in the world today. So that's, again, providing that steady, stable income stream as a portion of a Canadian's investment portfolio.
And one of the things that I know that you do in your firm is that you're looking at only 1 or 2 year mortgages. They're fixed rate mortgages, and you're very careful to cherry pick, who you work with. I think that's an important consideration. Whenever you have to buy a basket, you're buying a basket of mortgages, but that is almost by definition more risky from a credit perspective than, say, bonds or GICs. But risk and return are related. And bonds and GICs are paying whatever 4% these days. Mortgages are going to be seen as being slightly up, further along on the risk spectrum. I don't know. I don't know that I would say that they were a lot further up, but they are further up to some degree. But, if you're only going this much further on the risk, but you're getting this much more return, for the people who are listening on Spotify and on iTunes, the fingers are just a few inches apart the first time, and then the hands are about 1.5 feet apart the second time. Risk and return are related, but you're increasing your likely risk, but you're increasing your likely return. But I think the increase in likely return is greater than the increase in likely risk. So it's probably a worthwhile trade-off. What would you say are the main risks, just out of full disclosure, of buying a basket of mortgages?
Yeah, so there's a few risks associated with it. I think probably the number one is liquidity. We did talk, prior to the call. It's a monthly redemption for our strategy, as it is for a lot of mortgage funds. Mortgages aren't necessarily as liquid as a bond or bond fund. If the chips are down and you need access to your money with a bond, you can sell it and get that money fairly quickly. We ask for, we have monthly liquidity, and we ask for 21 days notice because at the end of the day, it's a basket of residential mortgages. So they're not that liquid. But again, part of our process is to have a heavy volume of mortgages. So roughly 2,500 mortgages are in our investment portfolio at any given time. And that in itself, to your point of having 1 or 2 year terms there, we do have some mortgages rolling over very, very frequently. So we can create some liquidity within the portfolio for people.
Yeah. And I think it's also worth noting that from a risk perspective, when you've got that many mortgages, even if there are 1 or 2 defaults, they're going to be relatively fractional. And so it's not like you have to worry about wholesale people not being able to make their mortgage payments. And then the other thing that I would say, just in fairness to you, that even though waiting a month with 21 days notice might be not so great if you're comparing it to a bond or a bond ETF or a bond mutual fund, but if you're comparing it to a GIC, you're locked in for, whatever it is, 12, 18, 24 months between when you buy the GIC and when it matures. And there's really no liquidity in the interim. So it is a question of, what would you have invested in as an income producing vehicle had it not been a basket of residential mortgages? And again, there's no right or wrong. It's just a question of making sure that you can connect the dots and have a reasonable risk appetite. What you could maybe talk a little bit about other types of mortgages. Other people who might want to invest in real estate or lending to real estate will be talking about retail or office or industrial real estate and lending to those sectors. Your lending is entirely to the residential space. Why is that?
Well, there is a number of different mortgages, as you just alluded to: industrial, office, commercial, etc., residential. We believe that residential mortgages, the homes that you and I live in, the homes that, Canadian families raise their children in and send them off to school in, we think those are low risk mortgages, especially if there's, solid equity in the portfolio. So again, that's another thing in our process that we look for is how much capital do the clients have in their own property? How much money do they have invested in their own property? If they've got 50, 60, 70% invested in their own property, they're much less likely to walk away. Canadians are great at adjusting and minimizing their luxury spending before they ever let their mortgage payment lapse or go or fall into default. So we think the residential space is a very conservative part of the mortgage market vis-a-vis kind of some of the rest of them. Office and commercial, hotels, those things, they can be very cyclical, even if it is in the mortgage space.
And again, my understanding is that with your offering, most clients have over half of the equity in their home, so that the loan to value is, between 50 and 60%, whereas the mortgage is for maybe relatively little, again, relatively little, less than $250,000 on average. So
Yes.
it's not as though there's going to be a huge amount of risk. Obviously, there's always the risk that something may happen and people lose jobs, and when economies slow down. But I think what I'm hearing from you is that despite the fact that there are certain risks, in the grand scheme of things, it's not that extreme. It's a relatively good way of looking at getting a risk adjusted return. What has the historical return been for residential mortgages over the past 8 or 10 years?
Uh, the broad-based asset class, I wouldn't have a number for, but I know our since inception number is just over 8.5%. If you reinvest the distributions, it's a little bit less than that if you take the cash quarterly and use it for your spending needs. But for clients who reinvest and buy more units as the income gets distributed quarterly, yeah, their since inception number is just over 8. I think it's 8.57%. That's after fees.
Yep. And then also, just in terms of risk management, what about second mortgages? Do you have a lot of second mortgages in terms of the way you do your lending, or
Yeah, no, that's a good question. And again, this can differentiate some mortgage funds from others, but we do have some seconds. We have about 36% second mortgages in the portfolio today. We're very methodical even about that part of the portfolio. We're very comfortable doing seconds behind the big banks, the Canadian big banks. We're comfortable doing a second behind a CMHC approved mortgage. We'll even do a second behind ourselves if we're in the first position. That's it. We won't do a second behind any other sort of bank or any other private lender, again, other than the big 5 banks.
All right. Okay. And then let's talk about one of the elephants in the room, which is gating. Your product is offered through offering memorandum, which is really only available for accredited investors. And that generally means you're making 200,000, or you and your spouse are combined to make 300,000, or you've got $1 million of net liquid assets. And there are a couple other tests, but basically it's really available only to certain people who are deemed to be a little more sophisticated than the average investor. And one of the problems with products that are offered for accredited investors, they're offered through a different structure called an offering memorandum. And sometimes these offering memorandum products are gated. And because of liquidity concerns, the mismatch between people wanting to redeem assets and actually being able to gain liquidity on a timely basis to provide it to all the people that want to get out, what happens is that the suppliers will sometimes put up a gate, and they'll say, well, you've got these units, they've got real value, they're retaining their value, but you can't get your money out. You're going to have to wait. And sometimes it's indefinite. Sometimes it's a couple of months. Sometimes it's more than a year. What are your thoughts about gating in general, and what has the experience been with Capital Direct?
For sure. So that's an interesting topic, and I'm glad you brought it up because there's two sides to gating, right? Gating, of course, in this industry was put in place. It's put in place to protect the investors that are in the investment fund, and sometimes it happens because there's different places that are calling for money. Maybe there's mortgages that have been approved, so money has to go out and advance those mortgages. But at the same time, maybe there's more investor redemptions than usual. And so you have to fund a larger amount of investor redemptions. And then all of a sudden there's a strain on that cash. So that's the great point that you're making, is that sometimes companies have had to say to investors, we have to kind of be methodical about how we get you that cash out. So you can't have it all up front at one time. And that was put in place just to protect the investors that are in the fund. We've never had the gate before. We do have it in our OM documentation, just like every other, right, OM fund. We've got the parameters in there that if, certain things happen, we can gate and kind of reduce and limit the amount of redemptions that go out to our clients on a quarterly basis. Thankfully, we've never had to use that yet. We've got a very strong inflow of capital coming in. Again, with the consistent, dependable returns, it seems like Canadians are really kind of coming to us for some of that income need at this point in time, vis-a-vis some other solutions. So we've never had to do that yet, but it is in our paperwork that if we got into the situation that some of these others seem to be getting themselves into, the opportunity could be there as well. But it's looked at from the investment community as a bit of a negative. Companies that have had to gauge, especially for long periods of time, as you mentioned, it can be very tough to come out from that once you've lost trust from your investors.
All right, so let's see if we can paint a picture of what a typical investor in a basket of residential mortgages looks like. So the people who buy products such as yours, where you're buying a basket of hundreds of residential mortgages, what is their demographic? What is their income? What is their risk profile? Sort of typical investor that you would say wants to buy into residential mortgages.
Yeah, there's a swath of different investors, but I'd say probably some of the most common are, retirees or near retirees who are looking for, an enhanced or an increased income stream. They've worked hard, they've built up that nest egg, and now they're going to start drawing income from it. Maybe GICs at 3.5 or 375, whatever they are today, don't seem all that appealing. And a mortgage fund that can show them returns over 20-year period of consistently being in between 7 and 10% after fees might be an area where they want to put a little bit of their nest egg in to just get that enhanced return from it. And so because we distribute interest income as most mortgage funds do, being in a tax sheltered investment like an RSP or a RIF or a TFSA really makes great sense. Having said that, we have about 40% of our investors outside of registered plans. So in open accounts or corporate accounts, those types of things. And I guess the premise there, I always say the premise there must be, if they're willing to lock up for, 3, 4, 5 years in a GIC at, call it 4% today, why not go into something that's going to offer, double that or slightly more perhaps, and have monthly liquidity, quarterly distributions.
All right. So the podcast is called Make Better Wealth Decisions. And I always like to end by asking my guests to offer their thoughts about decision-making in the wealth management space. So if it was up to you, Gord, what advice would you give to people listening today to help them make better wealth decisions?
I think the greatest piece of advice to give Canadians today is work with an accredited investment advisor, especially if you've got a reasonable amount of wealth. Even if you're just starting out, the advice that's available through an investment advisor, it's incredible. And I would say work with somebody that's been in the industry, that knows what they're doing. Somebody, like yourself, John, been around for a little while and understands and does research and writes and things like that. Leverage off the expertise and the experience of these folks to help you reach your goals.
Well, that's very kind of you. And I want to thank you for your time today, Gordon. It's been a real pleasure, and good luck in all you do, because I think the space that you have is unique. And I think it's going to be quite useful in terms of helping people build better portfolios to get better risk-adjusted returns. Thank you.
Thanks, John. It was a pleasure talking to you today.
This podcast is not to be construed as offering specific investment advice. Please consult a qualified advisor before acting. My books, Stand Up to the Financial Services Industry and Bullshift, are available online. If you'd like to meet to discuss how the topics in this podcast affect you directly, please visit my website.